much. Our next guest says President Trump firing Jerome Powell is, quote, a terrible idea that would only have negative long-term consequences. Loretta Mester is the former president of the Cleveland Fed and a CNBC contributor, someone that knows an awful lot about the inner workings of all of this. We're lucky to have you here. Thank you so much, Ms. Mester. I guess just to get started, what was your general take on how today's events played out and what you think should or should not happen?
Well, it's just another comment from the president about Jay Powell, unfortunately. And I think the vitriol has gotten ratcheted up under this president. I agree with Steve Leisman that you can point to past episodes where presidents have expressed their views about monetary policy and in most cases wanting lower interest rates. And in particular, it seems to happen before elections, which you'd expect. But we haven't seen this kind of vitriol, and we haven't, as far as I know, really gotten to public remarks about firing the chair of the Fed. I do believe that would be a terrible idea. And, you know, even putting myself in the administration's, shoes, I don't see how it helps them at all. It certainly would not be a pro-growth strategy. It certainly would not necessarily, even if you get a chair in there who will lower short-term rates, it wouldn't necessarily lower long-term rates, which I know that President Trump and his Treasury Secretary have been focusing on because those do influence the economy. I think long-term rates could go up in response as those longer bond yields incorporate higher inflation expectations and concern about lack of independence in monetary policy going forward, which means a higher risk premium for inflation in those bond yields. So I don't see how this can help in any way with the president's own agenda. And I think it would be terrible for the institution of the Federal Reserve. You know, we know from other countries and from a lot of research, whether you're a advanced economy or an emerging market economy, when the central bank is not able to set independent monetary policy, you end up with worse economic outcomes. And when the central bank can set an independent monetary policy, meaning one that is not influenced by short-run political concerns, you end up with lower, more stable inflation. And you don't have a cost because it turns out you don't get more volatile growth because of that lower inflation. So in all cases, you end up with better outcomes when you have an independent central bank. And I should say that independent monetary policy making does not mean a monetary policy committee that is unaccountable for its decisions. And I think Jay Powell has done his best to make sure that he is communicating the rationale for policy. He is talking to Congress. He is putting out reports on the economy. And so I think that is the accountability. And, you know, anybody can disagree with the policy perspectives of the Fed, and that's legitimate. And different people, even people on the Fed, have different views about policy in any particular meeting. But I don't think it's helpful to have a president go after the Fed chair in a way that undermines the stability of the committee and therefore the stability of the U.S. economy.
You know, we dig having you on here. I speak for everybody, but I'll ask you the following question, because when you're in a $37 trillion hole sitting on top of a $27 trillion economy, you're not going to grow your way out of that. You're going to devalue your currency your way out of that. And my sense is, I mean, that's sort of the plan all along, whether they acknowledge it or not. How closely are you watching this weakness in the dollar, which has been significant over the last 6 months or so?
Well, I think you're pointing out one of the reasons that you want to have an independent central bank, meaning one that sets policy to fulfill the goals that Congress gave it, rather than one that will inappropriately and lower interest rates, either to lower the cost of financing, which President Trump did say out loud. He has said that one of the reasons he wants lower interest rates is to lower the cost of financing the economy. And that is a very dangerous place to be. Devaluing the government debt is not going to help this economy. It's going to basically push things down the road, and we're going to lose the great position we have relative to other countries. We're going to undermine the value of the U.S., and you're going to see the dollar depreciate, as you point out, and you're going to see less demand for longer term U.S. government debt because of this.